I bet you've seen this chart. In fact, I know you have. It's the one with 2 lines on it. Investor A, who starts at 20, invests for 10 years and then just stops completely. Then investor B, who starts at 30 and keeps investing all the way until retirement. And somehow, magically, investor A, who put in less money over fewer years, ends up with more. Look, every personal finance blog runs this chart. Every podcast quotes it. Every book about money opens with some sort of version of it. The message is always the same. Time is everything. Start now, or better yet, start yesterday. And look, if you're 25 and watching this, that chart is genuinely quite motivating. But if you're 30, 35, 38, 50, 55, and you're sitting there with a pension pot that looks nothing like what the calculators say that you should have, this chart is not motivating. It's devastating, because the message you're hearing isn't start now. The message that you're hearing is, well, you've already lost. That is not great. But here's what nobody talks about. When you believe that time is the only mechanism for building wealth, running out of it, running out of time, starts to feel like a life sentence, doesn't it? But I'm here to tell you that it isn't. Because the people who actually know how this stuff works, the advisors, the financial planners, the people who sit across the table from people like you, people in your exact situation every single week, well, they're quietly playing a completely different mathematical game. One where late starters don't just survive, they genuinely win. Let me show you what I mean. So first, you need to understand a big trap, okay? Now, the compound interest formula is and looks incredibly complicated, but in plain English, just says this: money grows, and the longer it grows, the faster it grows, right? Time is the multiplier. Time is doing the heavy lifting with compound growth, right? You've all seen the curves. And when you've got 40 years, the curve eventually goes absolutely vertical, as you can see here. And that's the part that everybody gets excited about. But here's the problem. When your time is short, when you've got, say, 15 years instead of 40, the curve never really reaches that exciting part, does it? It just kind of plods along, mostly in a linear fashion with your contributions, never really hitting that magic that you can see there when it starts to exponentially curve. And when you boil it down, the numbers make this really quite brutal. The Office for National Statistics Wealth and Assets Survey, rolls off the tongue nicely, shows the median pension wealth from 45 to 54-year-olds in this country sits below £100,000, below 100 grand. Meanwhile, the Pension and Lifetime Savings Association, easy for me to say again, reckons that a couple needs an income of around 59, basically £60,000 a year to have what they call a very comfortable retirement. Now, that works out at a pot well over £500,000 each required to try and achieve that. So, picture this situation. Let's say that you're 50. Let's say that you've maybe got, 80,000, 100,000 in your pension pot. You need to get £500,000 plus. So what do? You open up a compound interest calculator, you plug in your numbers, and you ask the golden question. What would I need to save every single month at a normal market return to bridge the gap of where I need to be? And the number that comes back is just absurd, right? £3,000, £4,000, £5,000 a month. Match maybe more than you're actually bringing home in many cases. And what do? You just stare at the screen and something in you just shuts down, doesn't it? Just gives up. And this is the first layer of a big trap. And I call it apathy through arithmetic. See, you see that the numbers just don't add up using all of these rules that everyone taught you. So what do? Like I said, you just stop trying, don't you? You give up. Oh, it's never going to happen to me. You just leave money sat in your bank account doing nothing, and you stop opening your statements. But here's the thing. Apathy isn't the only danger. Doing nothing is not the only and biggest danger that I see. You see, some people that I come across absolutely refuse to give up, rightly. And honestly, that can be where it leads to a more dangerous factor. And it really does get dangerous when you see this happen. Here's what happens when a late starter looks at those impossible monthly contributions and decides, no, I'm not surrendering, but I'm going to take some risks and I'm going to figure this out. Here's what happens. Their brain reaches for kind of like the only lever that they have left. If you haven't got time and the contributions, they think to themselves, then, okay, the only other lever I have is to make my returns bigger. I need a higher rate of return. The market average of like 7% a year is not going to cut it. I need 12, I need 15, I need 20. So what do? They move their pension pot into something crazy. They move it out of boring, diversified, predictable funds into like crypto, into single tech stocks, into heavily geared investment funds, into whatever they read about on Twitter that someone insists is going to go to the moon, right? And on paper, the maths might even just work. If you can hit the 15% a year for 15 years, you probably genuinely can catch up. The problem is what nobody tells you about with that equation, something called sequence of returns risk. Now, sequence of returns risk is just a jazzy phrase, but essentially it just means this. When a crash comes, and crashes, of course, always come, the when part really, really matters. It matters enormously. When you are 25 and you've got a small pot of, say, £20,000, a 30% market crash is not a disaster. It can hit you, but it's not going to wipe you out. The reality is that's actually just a buying opportunity, right? You've got tiny amounts invested and 40 years to ride it out. The market always recovers, typically, and your future contributions are buying in at a sort of fire sale prices. But when you're 55 with a much bigger pot, and that same 30% crash hits a portfolio loaded with high risk assets, the picture is completely different. Your capital base is now meaningfully large. You've got that £400,000 sat there on average because you've spent your peak earning years stuffing it full of money. Now, that 30% loss isn't theoretical. It's tens, maybe hundreds of thousands of pounds gone, unless you ride it out, and if worse, if you sell. But the reality here is that you don't have 40 years to wait it out. You've got what, maybe 8, maybe 10 years before you need to start leaning on that pot and drawing money out of it. You can't recover with as much certainty as, say, a 25-year-old can. The market might eventually, but your retirement, the one that you specifically need to fund a specific life at a specific timeline, can't with as much certainty. So that is the second, more dangerous layer of the trap. Chasing yield, chasing returns to replace missing time isn't a strategy. It's gambling with your livelihood. The first layer, apathy, destroys you slowly through inaction. The second one can wipe you out in a single bad month, a single bad year. So the question then is, if standard compounding, because you haven't got the time, is out of reach, and high risk yield and return chasing can destroy you, the question is, how does a late starter actually win? This is where the entire game changes. You see, late starters, don't need to catch up on time. In fact, as I said, that option just isn't available to them. What they need to do is stop playing the time game altogether and switch engines entirely from time to what I call structural efficiency, and more specifically, the structural efficiency in the UK tax system. Because here's the secret that not a lot of people talk about, and certainly not loudly enough. The UK tax system is bursting, right, with hidden mathematical advantages that, if you understand them properly, give you guaranteed returns that no stock market on earth can match. Not over 5 years, not over 10, instantaneously. Let me show you 4 of them. The first is salary sacrifice. Let's say that you are a UK worker earning £60,000 a year, right? That puts you in the higher rate tax band. You will be paying 40% income tax on that top slice of earnings above roughly £50,000. Now, imagine that you've got £1,000 that you want to save for your future. If you take that as take-home pay and then put it in something like a stocks and shares ISA, fine. It just sits there and slowly compounds, right? Standard stuff. But what if instead you used salary sacrifice, moving some of that money, the same £1,000 gross from your salary, directly into your pension before tax even touches it? You would avoid 40% income tax. You also avoid the 2% national insurance that you'd also otherwise pay on it. The total cost to your take-home pay, the actual kind of money out of your pocket, is just £580. You've turned £580 of spendable cash into £1,000 of invested assets. That is a 72% return on day one, risk-free, guaranteed, done. Now, think about what that actually means, because this is an important framing, I think. To get 72% return in the stock market at a normal, let's say, 7% real growth rate, you'd have to wait nearly 8 years. 8 years of like market exposure, market risk, all the ups and downs, sequencing risk, all of it. The late starter can achieve that exact same outcome in one payroll cycle through tax structural efficiency. The young investor's 8 years of waiting compressed into 1 month. Into 1 month. That's not catching up. That is leapfrogging. The second one is, I think, even more powerful, and it's hidden inside what most people consider to be one of the most punishing parts of the UK tax system, the 60% tax trap. Here's how it works. So when your income, much like the basic rate tax threshold, when your income climbs above 100,000, HMRC starts taking your tax-free personal allowance away. That's the bit at the start, roughly £12,500, where you pay no tax at all. So you actually do pay tax, weirdly, but actually it's just taxed at 0%. So it's not tax-free, it's taxable, but the rate is 0. Anyway, doesn't matter. Specifically, you lose £1 off that personal allowance, the bit at the start that you have tax-free, for every £2 that you earn over that £100,000 threshold. So by the time that you hit £125,140 of income, the entire personal allowance at that front end is gone. The maths of that creates an absolutely brutal effective tax rate. Between 100,000 and £125,140 of income, you're not just paying the 40% income tax at the high rate tax threshold, you're effectively paying 60%. Because, of course, you're paying the 40% of high rate tax, but you're also paying more at 20% because you've lost that personal allowance as you go. For most people, that is an absolute horror story. And I genuinely believe that that factor is one of the biggest things that actually stops high earners building genuine wealth. It's one of the big motivating reasons why I do these videos, why I started. But if you frame it in a completely different way, for a late starter aged 50 who's behind on retirement, that 60% tax trap is an absolute gold mine. So picture a 50-year-old earning £120,000. If they take, let's say, that top £20,000 as just pure take-home pay, after a 60% marginal rate, they'll pocket something like £8,000 a year. That means that HMRC has just pocketed an extra 12 grand. Lucky them. But if they redirected that same £20,000, rather than taking it as income into their pocket, if they've directed it straight into their workplace pension, the entire £20,000 goes straight in. They've just converted £8,000 of net wealth that they could have in their bank account into £20,000 of asset wealth. That is 150% immediate return on the money that they just foregone in their take-home pay. 150% instantly as well. No stock picking, no market timing, no risk. Instantly. You will never anywhere find 150% guaranteed return on your money in any market in the world. And it's just sitting there in the UK tax code waiting to be used, and people are not using it enough. I will bang this drum until I'm blue in the face. The third lever, the cherry on top, employer matching. Look, a huge number of employers in the UK will match your pension contributions up to sometimes say 5%, sometimes 8%, occasionally 10%. I've seen some crazy numbers. And there is an absolute shocking number of people, a number of workers in their 50s and even earlier who never max this out, because most people weirdly are just so laser focused on protecting their monthly take-home pay. Yes, salary sacrifice involves sacrificing some of your salary, obviously. But if you're not doing employer matching, you are missing out big time. But understand truly what's actually happening when an employer matches, let's say, a 5% contribution. That is a 100% return on your gross money for free, just by opting in. Now, when you stack all those things together, here is the absolute beauty. When you stack that employer match on top of high rate tax threshold relief and the national savings insurance from salary sacrifice, the leverage becomes absolutely ridiculous. This right here, this is all you need, okay? This is all you need to know. This is how you catch up. Forget everything else. Forget crypto. Forget all these other jazzy schemes. This is all you need. I promise you. A late starter who is aggressively maxing out their employer match is accelerating their wealth at speed. Speed that makes ordinary compounding look snail's pace. Okay, maybe you haven't got a workplace pension where you can take advantage of the employer match. Interestingly, I speak to so many people who will say to me, oh, I'm going to go self-employed because it's the way to get rich, isn't it? Or I'm going to start my own business, or I'm going to do all this sort of stuff. Just remember, when you do things like that, you are giving up so much benefit by being employed. Okay, really think about, do I want to go self-employed? Do I want to do all this stuff? Because, this is a bit of an aside now, I am so sick of seeing people be like, you've got to be your own boss, you've got to have hustle culture, you know, you're being used as an employee. I view it completely differently. I view it as the benefits of some employment, not all, obviously, is you get such great benefits. Employer match is one of them, holiday pay, sick pay, everything else like that. So just bear that in mind. That employer match in that equation right there makes a huge, huge difference. Okay, so really think about that. And the fourth lever, carry forward relief, right? Okay, this is the one that almost feels a little bit like cheating once you kind of understand it. So HMRC allows you to use up to at least £180,000 of unused pension annual allowances from the 3 previous tax years on top of the current year's allowance. Okay, so the current pension input allowance this year is £60,000. So if you're blasting way above that, and I know most people aren't going to be, but perhaps if you do, let's say you're a peak earning 50-year-old who's been steadily contributing modest amounts, but then suddenly comes into a much bigger income. Maybe a bonus is a classic example of this. I'll have people come to me that will say, I've just got like a 50 grand bonus or something. I don't know what to do with it. When you suddenly get a big lump like that, or maybe a business sale or inheritance or a redundancy package, whatever it is, you can shovel a serious amount of money into a tax sheltered environment all at once, right before retirement, exactly when you need it the most. Look, the caveat here, of course, is that you still have to have what's called the UK relevant earnings to get tax relief. So if you wanted to contribute, I don't know, £100,000, you'd have to earn at least £100,000. The key thing is you have that capacity. Let's go back to that. You have that capacity for like 240 grand's worth of allowance over these years, but you'd have to be earning 240 grand, and when it gets to that level, it tapers off anyway. But by the by, just remember that you can only get tax relief on the amount of income that you've actually paid and got been taxed on. And look, here is where everything ties together, because this is the big part that gets missed, okay? By the time that you reach your late 30s, 40s, 50s, whatever, you are statistically at your peak earning power, right? Things like your mortgage in real terms is shrinking thanks to inflation. It's a good part of inflation. Maybe your kids' expenses are starting to taper off. Your career capital is probably like at the highest it'll ever be. This, my friends, the golden zone, as I call it, between like 40 and 60, this, my friend, is the window. This is when cash flow redirection becomes a superpower, not when you're like 25 and scraping by and just figuring out life right now. Look, the late starter, they're not behind. They're just playing the wrong game with the wrong tools, judging themselves with the wrong metrics. They've been trying to like run a marathon using a sprinter's metric. Once you stop chasing the time-based version of wealth building and start ruthlessly exploiting structural efficiency, tax arbitrage, employer matching, carry forward, salary sacrifice, the maths just completely flips entirely. You don't need a time machine. You don't, I promise you. You just need to stop playing the beginner's game. Now, we spoke about trying to not chase returns and make silly investments. So if you click up here somewhere, you can take a look at how I actually invest my money as a professional and follow the exact strategy that I use with high net worth clients. It's a strategy that has outperformed global index funds since 2017. I've been running it. And plus, one of the biggest factors in all of this is making sure that you actually know where your finish line is, the point where you have to stop relentlessly forgoing today to provide for your future. And that's why I really think you should watch this video here next, where I go through what I call the rich ratio, which shows you the exact point at which your assets can fund your lifestyle. So give it a watch. I think it'll be really, really useful, and I will see you there.